the 5C framework for credit assessment. In this part you will learn about how to assess a loan application by considering the risk issues. The 5C framework for credit risk assessment. This risk assessment framework comprises character, conditions, capacity and cash flow, capital and commitment, and collateral. This 5C framework gives an overall view of risk condition of the proposed borrower. The results of the 5C analysis are: main risks are identified, mitigation of those risks identified, a basis to accept or reject the loan, and a basis to structure the loan. The 5C analysis, character of the borrower. The borrower for a loan may be an individual or a business. They will be assessed in different ways. Character analysis of an individual should cover integrity and reliability of the person, knowledge and skills for employability or operating a business. Character analysis of a business should cover financial controls and checks of the organization and business, industry knowledge and expertise, and management ability of key managers. Unreliable and dishonest borrowers are a risk to the lenders. Poor work attitude, lack of job commitment and poor sense of responsibility at work are serious concerns. For a business, there has to be some system of financial controls to reduce the incidence of dishonesty of the staff as well as partners or family members in the business. The lack of skills or poor adaptability to change are also important. Understanding the business and ability to manage the daily activities of the business such as sales, stock control, and customer service are crucial to success in the business. The 5C analysis, character of the borrower. As discussed earlier, the basic analysis of the character of a borrower would include an assessment its integrity, that is, honesty and reliability, and skills for business or employment. A borrower of low skills and poor integrity is a high-risk borrower to the lender. The 5C analysis, analysis of the character. Integrity and reliability has always been the traditional focus of lenders. It is about the degree of reliability of the borrower, and its management, and the sense of financial responsibility of the decision makers. A borrower with little integrity or unreliable one would make enforcement of loan agreement costly, difficult and time-consuming. The difference between reliability and integrity should always be noted because they are not the same. The 5C analysis, analysis of the character. Experience, knowledge and skills. Knowledge and good skills are essential for generating income and staying successful in a competitive environment. Knowledge and skills of the individual in employment, or partners of a business are crucial to success. Experience is not knowledge and skills are more important because they are usable to generate income. Experience with little skills have little value too. The 5C analysis, environmental conditions. Analysis of conditions involve an assessment of the economic environment, business and its competitiveness, capacity of the borrower to maintain or seek new employment, and capacity of the business to stay in business. A business does not operate in a vacuum. It is affected by a combination of factors that can impact the cash flow potential. The borrower who is employed also runs the risk of losing his or her job if the business closes down. Therefore, understanding the borrower's company or employer would be important too. The analysis of economic conditions. The economic cycle. The economic cycle always goes from boom to bust, and it moves through the phases of expansion and contraction. At each phase there are different risks for the borrower and lender. Some businesses close down during the C stage while some may prosper. Generally, market demand is good during the economic boom, and people spend money while businesses expand and employ more staff. When the economy begins to decline, unemployment increases, businesses shrink or even close down, and consumer cut spending. The analysis of economic conditions. Similarly, the global economy also changes. In addition, the modern global economy faces frequent disruptions caused by policy shifts of major world economies, speculative activities in the commodities markets and the financial system, political and social objectives of the various countries, and natural disasters and crises such as new diseases, earthquakes and extreme dry weather. The borrower's employment or business may be affected by a change of those conditions. Economic gloom occurs when spending and economic activities are reducing, Economic gloom can be viewed as different variations of the downward cycle with various possible reasons: long recovery duration, medium-term recovery, quick recovery. The diagram here typifies the situations. The analysis of economic conditions. When the economy starts to decline, banks, lenders and businesses become concerned about their cash flow and revenue. A long decline in the economy is very serious and will not encourage businesses to stay open and keep their staff. Those businesses that see a long recovery will likely shut down their operations to conserve capital. Lenders with outstanding loans will probably suffer big loan losses. A medium term of decline is more bearable, and many businesses may struggle to keep their operations and staff, hopeful for economic recovery. Where the economy declined quickly and very sharply but recover soon after, the condition is referred to as an economic correction. Businesses and government policymakers prefer this N-shaped situation as this is for a short time and it clears off excess competition. Cash flow analysis. Cash flow analysis of the individual borrower should be focused on cash flow generated from regular employment and other income, current and future cash flow commitments such as loan repayment and living expenses, and spending habits. Stability of employment income is an important risk for the lender. In addition, the ability to secure long-term employment with available skills must be considered too. Change of business policies and environment may cause unemployment. Therefore, the borrower must have the ability or skills to obtain alternative employment quickly. Spending habits and financial commitments can also reduce the cash flow availability. A borrower with high financial commitments might be under pressure whenever income falls. Cash flow analysis of the business borrower. Cash flow from the main business activities should be the focus for loan repayment ability of a business borrower. The analysis covers cash flow generating ability and its stability, and the current and future cash flow commitments. Strong cash flow generation today does not guarantee future cash flow for loan repayment. Changes of business policies and in the environment can reduce the future cash flow. Also, spending habits and financial commitments can reduce the availability of cash for loan repayment. Analyzing cash flows. A loan made today is repayable tomorrow. It is the future cash flow expectation that drives the loan decision, the decision on whether to lend or not to lend, size of the loan if so decided, term of the loan, and the loan repayment plan. The lending officer will then focus on future cash flow prospects of the borrower, covering sources of stable cash flow, size of future cash expectation, risks of cash flow shortage, future cash commitments, and possible misuse of cash flow. Analyzing cash flow. Understand the adequacy of cash flow. Strong cash flow is one where the prospective cash flow is much bigger than the loan repayment requirement, and there is a big margin of surplus cash flow to absorb the risk of any decline of cash flow. A weak cash flow condition, on the other hand, is one where the prospective cash flow is small and just enough to meet expected loan repayment, and the margin of surplus cash flow to absorb a decline of cash flow is too thin, or not available. Analyzing cash flow. Understanding the financial commitments. A borrower has low financial commitments if the proposed loan repayment need is within the expected cash flow income, all other current commitments are not unduly large, or there is sufficient surplus to meet unexpected needs. A situation of big financial commitments is one where the loan repayment needs constitute a very part of the expected cash flow income, and the available cash for any emergency is low or unavailable. Analyzing cash flow. The debt servicing capacity. The main focus in cash flow assessment is the debt service potential. This is the relationship of available cash flow matched against loan servicing requirements. This is represented by the DSR, or the debt service ratio. DSR equals available net cash flow divided by the debt servicing need. The diagram shows the debt servicing ratio is 4 times for year 2015, and it will begin thereafter to decline as debt servicing increases without any increase in the available cash flow. By the time 2017 arrives, the DSR would be at a dangerously low 1.3 times of debt servicing requirement. Analyzing cash flow, the debt servicing capacity. The main focus in cash flow assessment is the debt service potential. This is the relationship of available cash flow matched against loan servicing requirements. This is represented by the DSR, or the debt service ratio. DSR equals available net cash flow divided by the debt servicing need. The diagram shows the debt servicing ratio is 4 times for year 2015, and it will begin thereafter to decline as debt servicing increases without any increase in the available cash flow. By the time 2017 arrives, the DSR would be at a dangerously low 1.3 times of debt servicing requirement. The 5C analysis, capital and commitment of the borrower. Business activities carry significant risks, and the rewards of a successful business belongs to the business owner. Therefore the borrower and its owners should show capacity to take on the risks. For an individual borrower, the same principle applies. As the borrower enjoys the benefits and results of the loan, the borrower should make a commitment and responsibility by putting up more capital. The level of capital in the business indicates both the capacity to take risk as well the commitment the owners are putting in. Similarly, when a borrower buys a car, the person should put up a reasonable upfront payment as a display of commitment and responsibility. The 5C analysis, capital and commitment of the borrower. The diagrams here shows 3 businesses with different levels of capital indicated by EQ, or equity. Diagram A is one with a big or strong display of commitment by the owner of the business. On the other hand, Diagram B shows a poor level of commitment or risk-taking capacity compared to Diagram A. Diagram C is one that shows a large borrowing or liabilities as compared to Diagram A. The risk for the lending bank would be rising already at that level of liabilities and capital. This is where the lending bank or creditors may request further commitments by asking for guarantees or collateral before it becomes something like B. The 5C analysis, capital and commitment of the borrower. The individual borrower should demonstrate commitment and prudence when making a borrowing. Without such a display, it would be seen as reckless, and would be putting all the risk on the lender. On the other hand, business activities carry significant risks. The business borrower and its owners should have the capacity to take on these risks. This also indicates their commitment and confidence. As the economy moves in phases, there will be risks to the business and employment. Therefore the owners as the main stakeholders, must have the show commitment to meet these risks and the ability to sustain for the next upturn. The 5C analysis, collateral and loan protection. Traditionally collateral forms the main source of cash flow for repayment, especially on loan default. When a borrower defaults, the security or collateral will be realized and the money available will be used to repay the loan. Today's environment is different. A loan is made based on income-generating ability of the loan applicant. If there is no clear picture of that prospects, no loan would be granted. Security is not considered as a source of repayment because future marketability of the security assets is not assured. At that time, there may be no buyer for the asset. The character and quality of the assets would also change in time. Some assets suffer loss of value, such as a car. Collateral analysis. Primarily, the security asset serves as an instrument of credit discipline. It is used to encourage the borrower's compliance of loan terms and conditions, and to reinforce borrower's commitment to the loan obligations. It may be a possible source of cash on liquidation, to reduce the prospects of total loan loss if there is a default, and to prevent other creditors to claim the assets ahead of the bank, if there are many creditors. Collateral analysis. To be an effective instrument of discipline, the collateral must be of significant value or importance to the borrower. A collateral of weak or poor value is not a threat to the borrower. Therefore its value or power to force the borrower to act will be minimal. All security assets must also be covered by adequate insurance against loss by theft or fire or any other damage. Collateral analysis. Collateral is of good quality if it meets the following features. Physically in control by the bank, can be sold at minimum loss, can be sold at minimum waiting time, has stable or rising value over time, and has no legal ownership restriction on transfer of title. Insurance policies for the assets should be endorsed in favor of the lender since the security has been pledged to the bank. This is important as the security can be destroyed, leaving the bank with no asset. In addition, renewal of insurance should be made at least 1 month before due date. Collateral analysis. Loan protection is through adequacy of asset value and the ability to transfer ownership. A low asset value might not be able to meet the costs on its disposal and the loan outstanding. The adequacy of security value is assessed by way of the security loan coverage ratio as shown here. In the case of B, there is a situation of the loan being undersecured. Here are the typical assets provided as security by business borrower. Some for the assets are good security such as land or buildings. Others like machinery may be subject to depreciation and need repairs and maintenance. Although cash and deposits are of high quality, they are often lost before the bank can access them.